unprecedented. No developed Western country had defaulted in any way on government debts. Basically,
The summer of 2008 saw panic across the globe.
It was that bad?
Well, if you look at the major...
My employees, my shareholders, creditors, clients have taken a huge amount of pain. I wake up every
The epic story of the global meltdown continues.
The American people are angry.
Those banks needed to be held accountable.
Inside the politics of the financial crisis.
The U.S. housing market has been on fire since the start of the COVID pandemic, which has both buyers and homeowners now questioning whether or not the U.S. housing market is about to crash. So today, let's talk about the history of the housing markets and what are the possibilities of another housing crash just like 2008. All right, first, let's take a look at the current market. See, since the start of the pandemic, people have been wanting to find their own place to settle down now permanently more than ever. That caused demand to shoot up, especially as the low interest rates and incentives for purchasing resulted in the median home prices dramatically rising up 39% since the start of the pandemic. And working virtually gained popularity. Workers spread throughout the country searching for more space. This led housing prices rising in previously affordable areas and communities further from the major cities, like the rural areas. Mortgage rates have been at an all-time low while prices have soared. Interest rates grew high, mimicking other periods like the 40s and the 70s and even the early 2000s. Another factor that heated up the market is that there was a shortage of houses. Houses were snapped up within hours of being placed on the market, and they were selling usually for over asking price. On a day that there was an open house, you'd see lines and lines of cars, people just looking to look and maybe make an offer or a bid. Because of this, America is experiencing a housing affordability crisis, where the median American worker is struggling just to afford a normal home. This means that they must rent, which is actually a pretty costly option. Rent prices have also increased since the start of the pandemic, as much or even more so than housing prices. What we see lately is possibly the end of an extreme housing boom. We'll get into the reasons why this may cause a slight decline in prices, but not a total crash like the great financial crisis of 2008. Let's go back in time to delve into the U.S. housing markets of the 1940s, the 70s, and 2008. And we'll see how they compare to the present day, because what I discovered might just shock you. So, at the start of the 1940s, home ownership was at an all-time low. World War II was in full force, and due to the Great Depression, new home production had dropped dramatically. Inflation was high, which caused house prices to rise over the decade during this inflationary bust. The U.S. government increased housing constructions post-World War II, which caused the development of the suburban areas. This was partially due to the VA's Home Loan Program of 1944, also known as the GI Bill. This program guaranteed millions of home loans to veterans and their families, allowing them to build homes. Builders took advantage of the millions of people that were returning home and looking for a place to live. New homes and defense urban centers became accessible for most of the war vets. All of this development and home purchasing helped kickstart America's economic growth after World War II. All right, so now let's check out what happened in 1970s. From 1973 of November to March of 1975, America experienced a recession where the economic stagflation had occurred. And this is where unemployment rose and you have inflation also getting higher. But we're also in the middle of a recession. So to combat this, the Fed created policies to generate employment. This included lowering interest rates and making it easier for banks to loan money to the general population. Unfortunately, this resulted in high inflation rates by cash losing value. Inflation ultimately occurs due to the money supply. If it increases faster than the supply of goods, you're going to have inflation. The oil shock didn't help either. See, in the 70s, we also had an oil embargo, which means that America couldn't get any oil from OPEC. So this placed the country further into a recession. High inflation and high unemployment existed simultaneously in America during the 70s, while gross domestic product, or the growth rate of America, slowed. Well, you got to ask yourself, what effect did this have on the U.S. housing market at the time? Well, during a period of high inflation, house prices followed suit and it rose more dramatically. It cost more for materials and wages. Consequently, building new homes costs a lot more than before the recession. Yet, for any consumers that had purchased a home with a mortgage prior to the boom, well, they saw the most benefit. This benefits because the mortgages are fixed and the amount that you owe doesn't change, even if the house value increases over time. These rising prices made it harder to get into the real estate market, and it reminded people of the potential losses that they would incur by not building wealth in the real estate. The Federal Reserve eventually raised interest rates as high as 20%. This affected the housing market as interest rates played a significant role in the prices of the house. With these rising interest rates, many people could no longer afford to buy homes. Something to note is that the recession in America was caused by two unrelated to housing factors. This meant that the residential real estate market was not nearly affected as much as other industries, but it may give you guys a hint as to what might happen in our current market. So, fast forward to 2008. This is the year of one of the worst periods in the U.S. financial market history. It all started with growth of the subprime mortgage market in 1999. Subprime mortgages really were for people with less than ideal credit scores and usually a lack of savings. Initially, they were designed to make loans more accessible to less wealthy people and allow them to live out the American dream of owning their own homes. The U.S. government-sponsored mortgage lenders gave money to these people who were likely to default on their loans. Not only that, these loans had special conditions to combat the lenders for taking the extra risk on the borrowers. Mortgages had a higher interest rate and mostly variable options. Now, the only way this type of a system would work is if prices remained rising as well as interest rates remain low, which that's never going to happen. So, borrowers and lenders alike were encouraged to make risky decisions as housing prices rose and loans seemed to be risk-free, which we all know wasn't the case. Well, it did seem to work out well to trend up the market until like the mid-2000s. And suddenly, there was a considerable supply of newly built houses and prices began to trend down. This is when the market started to decline, and many borrowers began to miss their payments. Homeowners were defaulting and stress in the market rose. Many homeowners had mortgages that they couldn't repay, and now they were worth more than their houses, which meant they were upside down. The 2008 housing market crash took its toll on millions of homeowners in America. It caused turmoil in the financial markets of our country. The U.S. housing market of 2008 crash ultimately led to the collapse of the stock market and the Great Recession, which was a global event. It was the biggest housing shock in American history. But will it ever happen again? Let me know in the comments if you think there's going to be another repeat of what happened in 2008. I'd love to hear. Or has America learned from the past and won't make the same mistake again? Now, since the 2000s, there have been two significant U.S. housing price spikes. One that led up to the 2008 housing market crash, and one that hit on the onset of COVID-19 pandemic. Does this mean that there'll be another housing crash like what we saw in 2008? Well, maybe not necessarily. You see, currently, the post-pandemic spike in the U.S. housing market looks like it's trending down. Mortgage rates are rising, which if someone were to purchase a house, they would have to pay more each month for the repayment. This decreased the number of people rushing in to buy homes. Another reason the trends are pointing down is the high prices and low supply of homes. Since the start of the pandemic, prices of homes in America have risen 43%. No wonder the average American can no longer afford a new home. Home building is declining. Builders are decreasing their production right now of new houses, as the demand, these higher prices seen in current times is not likely as high as it once was, which is a good thing for our market. The current drop in the U.S. housing market trends has caused potential buyers to ask a good question. Is the market about to crash? Suppose policies drop dramatically, which demand was lower. In that case, these buyers are hopeful that the market will crash and provide them with an opportunity to buy something at an affordable price. Many people have been waiting for the crash since the housing market picked up again after the 2008 crash. Yet, I think it's unlikely that we're going to see a repeat of 2008. House prices remain high due to high inflation, yet a crash isn't really on the horizon. First of all, you have a really low level of inventory and you have still a lot of demand for people needing a place to live. So there's actually a shortage of places to live, which is why the housing market is held up so firmly. Secondly, lending has become more strict. America has learned from its mistakes and no longer encourages risky loans or subprime mortgages, which was the leading cause of the 2008 housing crash. There are strict standards these days, and borrowers must prove that they have good credit scores and enough savings. Another big thing to keep in mind is that houses caused the recession of 2008. But normally, recessions bring house prices higher. Okay, so what does all this mean to all of us, right? I mean, all this good information, what does this mean to us? We see the home prices may have dropped slightly, but nowhere near the extent that it was seen in the US housing crash of 2008. Now look, it's impossible for anyone to predict the future, but to prepare, all we have to do is look at the past. All right, guys, thanks for watching. I hope this was helpful. If you did, consider liking, sharing, and subscribing. We'll see you next time.